Hey, welcome back to the channel, everyone. I am so glad you're here because today we're going to talk about something that has the potential to be one of the most fascinating turnaround stories in the stock market right now. We are talking about Opendoor. Now, I know this stock has been controversial. It has been beaten down, it has been written off by a lot of analysts, but at the same time, it has also built a passionate and dedicated community of believers who call themselves the Opendoor Army. These investors see something that most people are missing: the potential for Opendoor to rise, not just back to its old highs, but even to levels like $82 a share, or possibly into the triple digits over the long term. That might sound far-fetched when you look at where the stock is today, but when you really dig into the fundamentals, the leadership changes, the AI revolution inside the company, and the broader macroeconomic setup, you start to see that this idea isn't as crazy as it first seems. So today we're going to break this down step by step, look at what's happening behind the scenes, and explain why so many investors are becoming incredibly bullish. And if you're new here, I'd really appreciate you taking a moment to hit the like button, subscribe for more content like this, and join this amazing community that's growing stronger each day. Your support truly motivates me to keep putting in the time to research and deliver these deep dives for you guys. So let's jump right in. Everything I've shared in this video is purely for educational and entertainment purposes only. I am not a licensed financial advisor, and nothing in this video should be taken as financial advice, investment recommendations, or a guarantee of future performance. Let's start with something Eric Jackson recently posted that really shook a lot of people who follow Opendoor closely. Jackson pointed out that Opendoor's leadership has gone through some major changes that could redefine the company's future. He said, "How come you're not bullish on Open? The guy who wrote the business plan is now chair. The other key co-founder just rejoined the board. The new CEO left being next in line at $188 billion Shopify to run a $3 billion Open. Nobody does this unless they see it scaling way bigger. Cass, Keith, and Eric Wu, a sharper, more action-driven trio than Carp at Palantir. They've cut sg&a from 14% of revenue down to 4%. They plan to shrink headcount from 1,400 to 200 and replace with AI. They plan to explode buyers and sellers on the platform. You're not bullish enough. The road to $20, $50, even $200 is clear as day." That's a bold statement, and it forces us to pause and think carefully. Why would someone leave one of the most powerful and successful e-commerce companies in the world to take on a much smaller, struggling real estate platform unless they saw something massive ahead? When you put it in that perspective, it starts to become clear that this leadership change might be one of the biggest bullish signals we've seen for Opendoor in years. And Jackson didn't just stop there. He went on to emphasize that the person who could have been the next CEO of Shopify decided to jump ship for Opendoor because he presumably believes that this company could eventually become bigger than Shopify itself. That's a staggering idea when you consider Shopify's size and influence, but it isn't entirely out of the question when you realize just how large the U.S. housing market is compared to e-commerce. Housing is a multi-trillion-dollar industry. The pain points in buying and selling homes are massive, and no company has yet cracked the code to make the process seamless, fast, and trustworthy at scale. If Opendoor becomes that company, the upside is truly enormous. This isn't about hoping for a lucky short squeeze or a temporary pump. This is about positioning for a once-in-a-generation disruption in a market that touches nearly every family in the country. Now, to put this in further perspective, Amit, another investor who often comments on disruptive tech stocks, recently posted about Palantir and drew a comparison with Opendoor. He pointed out how Palantir was once left for dead, with short sellers like Citron calling for it to fall to $40, only for it to rebound to $170 later on. He highlighted how Citron, once loud in their criticism, has gone completely silent now that Palantir has proven them wrong. This is a pattern we've seen time and time again with disruptive companies. Analysts and short sellers pile on during the tough times, dismiss them as unprofitable experiments, and then once the turnaround comes and the stock multiplies, those same critics are nowhere to be found. The lesson here is clear. It's easy to dismiss companies in their darkest hour, but that's often when the seeds of their greatest comebacks are planted. If you made it this far, thank you so much for sticking with me. It really means a lot. I put a ton of effort into breaking these companies down for you and presenting both sides of the story. So if you found value in this video, don't forget to smash that like button, drop a comment down below with your thoughts, and share this with a friend who's into investing. Also, make sure you're subscribed to the channel and have that notification bell turned on so you never miss out on my future deep dives, stock updates, and market insights. Conley also weighed in with an important observation. He said Amit dismissed Opendoor as something that didn't align with his fundamental investing strategy. And here's the kicker. Conley suggested that Amit will probably end up buying at $82 a share once the fundamentals finally make sense to him. This highlights something crucial about investing psychology. Many investors refuse to buy a company when it looks ugly on paper. They want to see clean profits, rising margins, and a tidy balance sheet before they get in. But by the time all of that happens, the stock is often already up 5x, 10x, or more. That's exactly what happened with Tesla. That's what happened with Netflix. And that's what might happen here with Opendoor. Those who wait for perfect fundamentals may end up paying a premium, while those willing to take a calculated risk earlier could capture the real asymmetric upside. Anthony Pompliano, better known as Pomp, also added his perspective. He said, "It is shocking how many mainstream media outlets can't understand that Opendoor is not a meme stock. It is a company poised to be turned around by addressing one of the largest problems in society, buying and selling a home. If you solve one of the biggest problems, history tells us you are rewarded with one of the biggest companies. Doesn't mean it will be easy. There will be plenty of volatility along the way, but the company has a chance to execute one of the greatest corporate comeback stories in history." That statement really captures the essence of the bull case for Opendoor. Think about it. Buying or selling a home is often ranked as one of the most stressful events in a person's life, right up there with marriage, divorce, or changing jobs. It's complicated, it's slow, it's filled with uncertainty, and it's very expensive. If a company can use technology to streamline that experience, reduce costs, and give consumers more confidence, it would completely change the way people approach real estate. And just as Uber transformed how we think about getting from point A to point B, or how Amazon transformed how we shop, Opendoor has the potential to transform how we buy and sell homes. That is why people like Pomp and Eric Jackson are so bullish. They see beyond the messy financials of today and focus on the massive societal problem that Opendoor is solving. Now, let's make this more concrete by looking at a real-world example, Carvana. Stevio, who I often refer to as the Opendoor Army General, posted a chart showing Carvana's insane run. In 2021, Carvana was at $360 a share. Then during the COVID collapse, it cratered all the way to $4. Analysts called it bankrupt, unsustainable, and hopeless. Yet within just 2 years, it climbed back from $4 to $360. That's a 90x return. Almost nobody believed in Carvana at the bottom, but those who did ended up seeing life-changing gains. The parallel with Opendoor is striking. Today, Opendoor trades at around $9. If it were to have a similar recovery story, even partially, we could be looking at $90, $150 or higher. And remember, Carvana and Opendoor share a lot in common. Both are asset-heavy. Both operate in industries with thin margins. Both require huge amounts of capital and operational efficiency to scale. And both are trying to use technology to disrupt a very old, very inefficient process. Buying cars in Carvana's case, buying homes in Opendoor's. The lesson here is simple. Just because a business model looks tough doesn't mean it's impossible. With the right leadership, efficiency improvements, and market tailwinds, these companies can stage epic comebacks. Carvana's story is worth pausing on because it illustrates something very important about investor behavior and market psychology. When Carvana fell from over $300 to under $10, almost everyone assumed the company was finished. Analysts called it uninvestable. The media ran stories about its debt pile, and inevitable bankruptcy, and even long-term holders threw in the towel. Yet what those critics failed to notice was that Carvana was quietly restructuring, renegotiating debt terms, improving unit economics, and streamlining operations. By the time those improvements became visible in the financial statements, the stock had already exploded higher. The people who waited for the all clear ended up buying at $100, $200, or even higher, while the few contrarians who held their nerve at $4 reaped once-in-a-lifetime returns. This is the exact same setup that the Opendoor army believes is happening right now. They argue that Opendoor is currently in that Carvana at $4 stage, hated, doubted, and written off, but positioning itself for a massive, unexpected rebound. And let's not forget the size of the markets we're comparing. Carvana operates in the used car industry, which is big, but still a fraction of the housing market. The U.S. housing market is worth tens of trillions of dollars. Homes are the single largest asset most families will ever buy or sell. The fees, commissions, and inefficiencies in this market amount to hundreds of billions in potential revenue waiting to be disrupted. If Carvana, a company selling used cars, could rebound from near bankruptcy to become a multi-billion-dollar success story, then Opendoor's potential in housing is exponentially larger. That's why bulls see this not as a speculative gamble, but as a calculated bet on a massive addressable market with room for enormous growth. Another element to consider is the role of leadership and vision. Businesses that undergo turnarounds often succeed because of strong, decisive leaders who are willing to make tough calls. Think about what Satya Nadella did at Microsoft when he shifted the company toward cloud computing, or what Elon Musk did at Tesla when everyone doubted the EV revolution. In Opendoor's case, the arrival of a new CEO from Shopify is more than just a management shuffle. It's a signal of intent. Shopify is one of the most successful e-commerce companies of the last decade, known for its ability to scale operations, embrace technology, and empower sellers. For someone in line to become Shopify's CEO to leave that trajectory and take over at Opendoor tells us that he must see a once-in-a-lifetime opportunity here. He's not joining to play it safe. He's joining to build something transformational. The co-founders rejoining the board also strengthens this narrative. Founders bring passion, long-term vision, and an intimate understanding of the company's DNA. When they step away, companies can lose their direction. When they return, it often signals a renewed commitment to the mission. We've seen this play out in other companies. Think of Steve Jobs returning to Apple in the late 1990s, or Howard Schultz coming back to Starbucks during a rough patch. In both cases, the founders' return marked the beginning of a turnaround. Bulls argue that Opendoor's co-founders coming back could mark a similar inflection point. Now, let's expand on something Eric Jackson mentioned: the use of AI to replace traditional headcount. This is a massive development that could reshape the company's cost structure entirely. Historically, Opendoor has struggled with profitability because running an iBuying business is extremely expensive. You need analysts to evaluate properties, staff to handle transactions, and teams to coordinate with contractors, agents, and lender. All of that adds to selling, general, and administrative expenses. But what happens when AI can handle much of this work? Instead of needing thousands of employees, the company might only need a few hundred highly skilled workers, supported by AI tools that evaluate property data, predict market trends, and streamline logistics. This isn't science fiction. AI is already being deployed in mortgage underwriting, credit analysis, and real estate valuation. Opendoor adopting AI at scale could turn what was once a cost-heavy, low-margin business into a lean, technology-driven platform. Cutting SG&A from 14% of revenue down to 4% is not just a small improvement, it's transformative. It could be the difference between endless losses and sustainable profitability. And here's where it gets exciting. If Opendoor becomes the first mover in applying AI to real estate transactions at scale, it could build a moat that competitors struggle to match. Think about how Amazon built its logistics network and cloud infrastructure long before anyone else, creating barriers to entry that still hold today. If Opendoor cracks the code with AI, traditional brokerages and newer startups alike will be forced to play catch-up. That's why some bulls believe Opendoor could not just survive, but dominate the industry in the next decade. Of course, we also need to zoom out and look at the broader housing market, because no company operates in a vacuum. Real estate has been through a turbulent period, with high interest rates cooling demand, mortgage affordability reaching multi-decade lows, and transaction volumes falling sharply. On the surface, that sounds bearish for Opendoor. Fewer home sales mean fewer opportunities to generate revenue. But this is where the contrarian bull case gets interesting. The argument is that Opendoor is using this downturn to sharpen its operations, cut costs, and prepare for the next housing cycle. When interest rates eventually come down, affordability will improve, and transaction volumes will rise again. At that point, Opendoor could be a leaner, more efficient company ready to capture outsized market share. It's the classic idea of preparing for war during peacetime. While traditional brokerages are suffering and retreating, Opendoor is reinventing itself. When the market turns, it could emerge not just as a survivor, but as a leader. We've seen this movie before in other industries. Amazon during the dot-com crash, Netflix when it pivoted from DVDs to streaming, or Meta when it shifted focus to AI and efficiency in 2022. In each case, the companies that used downturns to transform themselves ended up stronger than ever. Bulls believe Opendoor is following that same playbook right now.